What is impermanent loss? How to minimize temporary losses in crypto? Impermanent loss, IL or temporary loss, is the risk that users bear when the profit earned from providing liquidity is lower than the amount they can get from simply holding that asset. Pure. The cause of the temporary loss is due to changes in the price of tokens that liquidity providers, called liquidity providers, LPs, have deposited into the pool, along with the liquidity pool's balancing mechanism on AMMs. However, this loss is called impermanent because the losses only really happens when the liquidity provider withdraws assets from the pool. May decrease or disappear if the asset's price returns to the price at which the liquidity provider deposited the asset into the pool. How impermanent loss works. How does impermanent loss occur? Impermanent loss occurs due to the liquidity pool's continuous rebalancing mechanism to match the fluctuations in token prices in the market. Basically, the process of temporary loss will be as follows. When a user provides liquidity, they need to deposit tokens, usually 2 tokens, into the liquidity pool of equal value. When the token price in the market is changed, but the token price in the pool is still the old price, there will be a difference between the token price in the pool and the token price in the market. This will provide arbitrage opportunities for other traders until there is no longer a difference between the token price in the pool and the token price on the market. However, it will result in the ratio of the 2 tokens in the pool being changed. At this time, if a user withdraws tokens from the pool, they will receive a different asset ratio than the initial ratio they deposited, resulting in the value of the asset they just received being lower than the original value in case they simply hold tokens from the beginning. The difference between the value received when withdrawing liquidity and when holding it externally is called impermanent loss, IL. Why still provide liquidity regardless of impermanent loss? Impermanent loss can cause losses, but basically it is still just a temporary loss located on paper and at that time. In case the token price fluctuates back to the old level, this loss will disappear and liquidity providers, LPs, will not suffer losses if they withdraw liquidity at this time. Furthermore, when providing liquidity, LPs will receive a reward of trading fees from that liquidity pool. To incentivize liquidity provision, pools often deploy strategies to compensate LPs for IL, typically charging high transaction fees. Therefore, LPs can earn more profit from fees to compensate for the temporary loss they incur. How to minimize temporary loss. Transient loss is an unavoidable risk when providing liquidity, but here are some strategies that can help liquidity providers minimize its impact. Choose low volatility asset pairs, mainly stablecoin pairs. Temporary losses occur when there are price fluctuations of assets in the liquidity pool. So, providing liquidity into less volatile assets can help mitigate this loss, preferably stablecoins, e.g. USDT, USDC. Choose a pool with high transaction volume and fees. As mentioned above, participating in pools with transaction fees will bring higher profits to LPs, thereby compensating for losses temporarily have to endure. Besides, you should also check the transaction volume in the pool. The more transactions there are, the more fees you receive. Wait for the asset price to return to its original level. The more the asset price deviates from the price you deposited, the higher the temporary loss you will suffer. Therefore, you can wait for the token price to return to the original rate and not withdraw liquidity until then. Providing liquidity with small capital. You can use this strategy to test and measure the risk from impermanent loss first. The profit and loss range can then be estimated to determine the more appropriate amount of capital to devote to providing liquidity. Providing liquidity into a single token pool. This way, you can eliminate the imbalance in price and token ratio of multi-token pools, thereby effectively minimizing impermanent loss. Fruit. Some platforms that support single token pool include Beefy Finance, Wombat Exchange. In addition, providing liquidity on AMMs using the Centralized Liquidity Mechanism, CLMM, is also a way to increase profits and optimize capital efficiency for LPs. However, the risk of impermanent loss must be borne, will also become higher. Therefore, users can refer and consider joining the pool on CLMM.